The rich W-2 earners don't try to own everything. They try to control it. Why? Because assets in your personal name are the first to be taxed, sued, or seized. Today, I'm going to show you the exact legal structure wealthy W-2 earners use to protect, grow, and direct their wealth without hiding a thing. And for those of you who are new here, welcome. My name is Alec Friel. I'm the CEO of Tax Saving Experts. And in the last 12 months, we've helped over 270 high-income W-2 earners legally save over $12 million in taxes. What you're about to see is the same blueprint we build for clients who earn over $300,000 a year. Simple moves that shift you from owning personally to controlling by design. So let's start with the shift in mindset required to stop owning everything in your name. Instead, start controlling what you own through a proper structure. Ownership in your name is exposed. Ownership through entities in a revocable living trust creates separation, flexibility, privacy, continuity. You can't change that W-2 is W-2, but you can change where assets live and how new income streams are structured. Consulting, real estate, intellectual property, that's the game. Move from personal ownership to entity guided by your trust. Now, why does that matter so much? Well, number one, risk and liability. You silo assets so one lawsuit cannot knock over the whole net worth. If something goes wrong in your bucket, it stays in that bucket. Number two, tax timing. For non-W-2 income, entities let you reinvest before distributions. Bunch deductions in the right year. Control when income hits your return. Your trust directs where it all lands cleanly and on purpose. And number three, privacy and estate flow. So you can skip probate, keep family decisions private, make succession plans clean, fast, calm. With that foundation set, let's build the structure. Start with the Revocable Living Trust. It's not only for the ultra rich, it's the organizing blueprint. Your trust avoids probate, keeps decisions private, names backup trustees if you're ever incapacitated. It gives you control after you are gone. Who gets what, when do they get it, and under what conditions. It protects your heirs from creditors, predators, and self-inflicted mistakes. It is super simple to update your trust as life changes. What belongs in the trust, your home, your non-qualified brokerage, membership interests in LLCs, aligned life insurance beneficiaries. And this is the most critical part of the trust is actually funding it. An unfunded trust is just a binder and some documentation. Quick pit stop. If you're thinking, I want to set this up correctly, hit the top link in the description, book a call with my team. We help high W-2 income earners protect more, lower their taxes, and put legal strategies in place to build long-term wealth. Just in the last 12 months, we've helped over 270 W-2 high-earning professionals legally save over $12 million in taxes. We'd love for you to be our next case study. Tap the link, choose a time, we'll get you moving in the right direction. All right, now let's design how money leaves the trust. Don't dump money in one shot. Use staged distributions. For example, portions at 25 or 30, 35 years old. Tie releases to milestones. Could be education. It could be when the first home is purchased or starting a business. Add guardrails for addiction or creditor issues. Include charitable goals if you want a legacy plan. A will says who, a trust says who, when, and how. And with the trust set, we add the second layer, entities. Create a holding LLC at the top. Under it, use separate asset LLCs. If you own real estate, one LLC per rental property, a dedicated LLC for your intellectual property, your brand, courses, a separate LLC for your consulting business. For a $300,000 or more high W-2 income earner, it looks like this. A consulting LLC for niche expertise. Could be an IP brand LLC for content and different licensing. Property LLCs for each rental. A holding company on top. And your trust owns the holding company. Brokerage accounts often stay personal for tax simplicity, but plan for liability and beneficiary alignment. Next, protect it with a layer of insurance. Add an umbrella policy, usually $2 to $5 million. Use E&O insurance, professional liability if you advise. Add cyber if you store client data. Make sure rentals have the right landlord and STR riders. Structuring your insurance is how you sleep peacefully at night. Now let's unlock the legal deductions. Start a legitimate side business. Launch as an LLC first. Elect S corporation when profits justify it. Then you can pay yourself a reasonable salary and take distributions. From there, we can get into more specifics. Add an accountable plan. Reimburse yourself for your home office, your internet bill, phone bill, mileage, equipment, pre-tax with receipts. Take it a step further. Implement the Augusta rule. Section 280A-G. Rent your home to your business for limited documented meetings. It's tax-free income to you and deductible and losses on the company when done correctly. Handle equity comp with precision. The right size RSUs withholding at each vesting period. Harvest losses on purpose. Where risk allows it. Hold targeted lots for 12 plus months to turn it into long-term gains. Tune your W-4 into a reality. Fill your tax-free buckets. Invest into your HSA. Use a mega backed backdoor Roth if your employer plan allows for it. Bunch giving with a DAF or donor advised fund funded by appreciated stock to avoid capital gains and get the deduction immediately. So remember, entities don't create magic. They create timing, documentation, durability, so your deductions can survive an audit. Let's talk about real estate, active and passive. For active, short-term rentals, keep average stays at 7 days or less. Track material participation hours. And if done right, depreciation can be non-passive and it can offset your W-2 income. Place the property into service, consider a cost segregation study in year 1, document your hours versus co-hosts and your cleaners and contractors. Passive investments, limited partnerships, LPs and funds, you'll receive K1 losses to offset passive income and gains. Carry losses forward if they're unused. Diligence sponsors, accept the illiquidity. And regarding the structure, each property, put it in its own LLC. Use a series LLC if your state supports it. Hold equity through your holding company with the trust at the top. Keep that veil intact. No commingling of funds, ever. Keep separate bank accounts. Use written contracts and invoices. Record simple minutes and resolutions when appropriate. Ensure your title assets are correctly titled. Align beneficiary forms. And be careful with personal guarantees. Negotiate caps, add insurance, or tie guarantees to entity assets, not your house. Let me show you how this exact strategy played out for one of our clients, Dan. Dan's a senior engineer earning about $350,000 a year as a W-2 earner. On paper, he looks successful. In reality, everything was sitting in his personal name. The house, 2 rental properties, a decent brokerage account. And every April, his RSUs blindsided him because the default 22 to 24% withholding never matched his true tax bracket. So he wrote checks, he felt behind, he gave to charity in cash every year, but never itemized. So the tax benefit was basically zero. There was no trust, no entities, no plan, just hoping the next filing season would string together less of a tax bill. Fast forward 12 months. After we built a simple structure, first, Dan signed a Revocable Living Trust, actually funded it. Home title aligned, brokerage assigned, entity interest moved under it. We added a $1 million umbrella insurance policy and confirmed home status for him. Then we created a holding LLC and a set of asset LLCs. Each rental property got its own LLC. His content and his IP lived in a separate LLC. We kept clean books, separate bank accounts, written contracts to protect the corporate veil. Next, we launched a small consulting S corporation for the niche work he was already doing on nights and over the weekends and on the side throughout the year. We set a reasonable salary, took distributions for the rest, and turned on the accountable plan to reimburse his home office, internet, phone, mileage, gear, pre-tax, with all the receipts. We also scheduled the Augusta Rule meetings throughout the year and papered them and recorded them correctly. On real estate, one rental became a short-term rental. We placed it into service, kept material participation logs, and ran a cost segregation study. That created meaningful depreciation in year 1, documented and audit ready. For generosity, we stopped the cash checks. Dan funded a donor advised fund with appreciated ETFs. He got the deduction this year, avoided capital gains on those shares, and still granted to his favorite charities on his usual schedule. On the equity comp, we tuned in the RSU plan at each vesting period. We pre-sold enough shares to match his real tax bracket, not the 24% default. And with the other strategies, offsetting some of that RSU income. We added tax loss harvesting cadence in his index sleeve and targeted 12-month holds where risk allowed. We also updated his W-4, so April matched reality instead of becoming a surprise. So what changed for Dan? Probate risk, gone. The trust directs everything privately and cleanly. The liability siloed. A lawsuit in one bucket no longer threatens the rest. April tax shocks, replaced with planned right-sized withholding and scheduled tax planning. The deductions, they're durable. We have an accountable plan, the Augusta Rule, short-term depreciation, donor advised fund timing, all papered and defensible. Privacy has been restored. His personal name is not tied to every asset. The estate flow, it's very clear. There's backup trustees, beneficiaries, and all the titles are aligned. Dan did not work more. He did not gamble on exotic investments. He simply stopped owning everything personally and started controlling it by design with a trust, clean entities, and the right timing. Now here's exactly how you can do the same. Draft and fund your Revocable Living Trust. Align titles and beneficiaries. Add an umbrella policy, $2 million to $5 million. Form your consulting LLC and elect S corporation when it makes sense. Implement an accountable plan. Build a holding company for your asset and different LLCs for each asset. Keep banking and your books completely separate. Never commingle. If you own real estate, use one LLC per property. Track your short-term rental participation if applicable or real estate professional status if applicable. Map your RSU plan, withholding at vesting periods. Find the cadence, create long-term lots, and tune in your W-4 withholding. Open an and invest into your HSA. Confirm a mega backdoor Roth features with your own employer and HR department. Create a DAF, donor advised fund, bunch giving with appreciated stock. Do an annual review of your entities and your estate docs. Update the trust and keep a one-page diagram of your structure up to date. Before you close this video and implement these steps, pause. Here's a few misconceptions you need to make sure you avoid. Number one, an LLC automatically saves me taxes. No, LLCs provide separation and protection. There's no automatic tax savings by having an LLC. Number two, a trust is an asset protection. A revocable trust handles probate, privacy, continuity. Protection comes from your LLCs and the entities, plus your insurance. I only need one LLC for everything. That concentrates the risk. Number four, put your personal car in the LLC. That can create fringe benefit problems unless it's bona fide business use. So all right, now you've got the moves and the guardrails. Here's how we can help you put this in place the right way. If you're a high income W-2 earner making over $300,000 a year and you want to protect more of your money, lower your taxes, and put legal strategies in place to build long-term wealth, tap the top link in the description, book a call with my team now. In the last 12 months, we've helped over 270 high-earning W-2 professionals legally save over $12 million in taxes using personalized tax strategies tailored to their goals and their specific situation. If you want to be our next case study, make sure you book that call. And if you'd rather keep learning first, watch either of these videos. This video goes over how we helped our client Vivek go from paying 6 figures in taxes to receiving a 20% tax refund in the first year working with us. Or you can watch this video where I cover the 4 types of W-2 taxpayers who are overpaying without even knowing it and simple moves to stop doing so. And remember, small structural moves this week beat big regrets come tax season or come April or when crap hits the fan. So click that link. We'll connect with you soon.